Just want to get your take on the action that we saw yesterday. Do you believe this is a realization of the concentration risk that so many people were worried about, or simply a reaction to the earnings that we saw?
I think it's both, and we can add on a few more things. It was just a few weeks ago that the S&P 500 was trading almost 15% above its 200-day moving average, which is extremely stretched. On the sentiment side, you had the Citi Panic Euphoria Index well into euphoria. The Investors Intelligence Bull-Bear spread was nearing 50. And then you throw in the fundamental factors like growth concerns, earnings concerns, as you mentioned. Now we are questioning whether all this AI spend is going to be worth it. And now you can throw in the stronger yen, which is resulting in a lot of carry trade unwinds. So you pile that all together, and to me, it certainly explains the sell-off, not just yesterday, but the shaking of the tree, so to speak, that we've seen over the past couple of weeks.
All right, so Philip, Peter believes it's a whole basket of things that led to the sell-off yesterday. Agree or disagree? One thing he hit on was the increase in AI spending. He's talking about, I believe, Alphabet's CapEx spending. Do you think that was a factor in the Alphabet report, which seemed to be a catalyst for the broader sell-off?
Yeah, I think I do agree with largely the statements there, that we ended up with a exceptionally overbought market here, huge rally into it. There's a lot of euphoria around AI and tech-related stocks in general. And the problem with it is that we've had this big gap open up between their market capitalization within the index and their earnings contribution, which is actually eroded. So there's been this massive air pocket, if you will, open up, and earnings have to deliver. And AI specifically, the spending on it not only needs to be useful, but continue at a very brisk pace. And there's some questions around that at the moment. There's also questions about whether there's some overspend in the near term and that might soften. And that's not good when you've got this air pocket kind of open up. And so given their contribution to the overall index, it's no wonder you're bringing down the indexes with a bit of a shakeout going with it. We'd see these stocks as quite vulnerable.
You know, it's funny you say just a bit of a shakeout. I was at the New York Stock Exchange yesterday. A lot of people saying this might laughed. A lot of people saying this might be start of a correction. We've had Craig Johnson from Piper Sandler here saying that a 5 to 10% correction could be on the horizon. So, Philip, I'm going to come back over to you. I'm just looking at Q3. Real estate's the best performing sector in Q3. I'm looking at small caps, looking at biotech outperforming the broader market and even the NASDAQ. In your mind, is this the sign that we could be headed towards a correction, or is it a healthy rotation or a healthy pullback? A lot of different terms that people are using.
Yeah, the challenge is the concentration of the growth-related mega caps are so big that you're going to bring down the overall S&P 500. But that said, underneath the surface, you've got a situation where, like, equally weighted, or a lot of other sectors don't look like that. So the mega caps have high earnings that are cooling and disappointing, whereas a lot of the other ones have kind of troughing earnings that are accelerating and have the potential to beat the bar. So I think you've got a situation here where, yeah, the overall index will feel the weight if you take a tech-related shakeout. But the equally weighted index and a lot of other sectors will do okay. We like financials, we like parts of the industrials, we like some of the energy space, and even healthcare if you want to go to the defensive. So we're looking for non-growth related, tech stock related assets, and we think you can still get some absolute gains in there. Okay. It'll be tough on the overall S&P 500 just given the weight of some of these, Meg 7s. All right.
Peter, I'm going to come back to you. Following yesterday's sell-off, where do we stand on these so-called election trades? BMO actually out with a note yesterday talking about small caps. A lot of people felt like small caps are part of the quote-unquote Trump trade. They said, in part, I'm summarizing it, we do not think politics matter all that much for this group to build on July's strength in the coming months. Even with this most recent rebound, relative underperformance remains quite extreme compared to historical standards. In your mind, what we're seeing when it comes to small caps, is this part of some type of election trade, maybe a Trump trade, or is it just simply a fact that they have a lower valuation and they're underperformed so far?
I think it's the latter, and I also think that it's the prospect of Fed rate cuts. We have to understand that a lot of these small companies have floating rate debt, where I've seen companies whose interest expense doubled over the past few years because of the sharp rise in short-term interest rates, SOFR borrowing, equivalent. So I think that any rate cuts from the Fed would give a lot of relief to the balance sheets of a lot of these small companies that are certainly more vulnerable to the rise in rates. So I think that really has been the biggest factor. And then, of course, you can throw in some mean reversion because, as you said, the spread between the big names and everything else has just gotten so wide.
So, Philip, Peter's mentioning the Fed. I know you have some very interesting thoughts about the Fed. You actually believe that July is a live meeting and there's a good chance we're going to get a cut. You're seeing something different than everybody else is. Looking on the CME, they only see a 7% chance of a 25 basis point cut in July. What are you seeing? And In your mind, would that stop any potential correction or slide if we do get that cut?
Well, first of all, on the cut, yeah, I think there's the Fed's intent on lowering policy rates. Now, for the record, we as a firm don't think that that's needed to sustain above trend economic expansion. So we think the Fed's kind of looking in the wrong direction. But it's adamant to cut rates. It's now got some soft inflation prints to sort of back it. The data that it was looking for, it has a tick higher in unemployment. Yeah, it's been mostly immigration and not really weakening employment conditions, but it'll use it as an excuse. So it has the foundation for a cut. The argument, it's televised September, which sort of makes sense as a base case. But if you've already got the data in place now and you've got month-to-month inflation being quite volatile, and right now you're at a low ebb and you've got a window, opportunistically, it could move on it.